Throughout the years, the property market has been a roller coaster of emotions, leaving us with more problems than solutions. Many have wondered whether or not the market would ever fully recover from the 2008 crash. After 10 years, however, we may have an answer to this age-old query. Is the housing crash over? Increasing prices in stocks are early indicators of a turnaround. But how much of this is based on wishful thinking? Stay with us till the end to find out. The U.S. housing market has cooled after a historic run that saw mortgage rates fall to record lows and house values rocket to record highs. In December 2022, house sales had dropped for 11 straight months, and home prices seem to have reached their pinnacle. There has been a slowing in both buyer interest and price growth, but economists and specialists in the housing market predict that any subsequent correction would be mild. Price decreases on the scale seen during the Great Recession were not anticipated. Among housing specialists, we're anticipating this is going to be a mild slowdown, is how Rob Dietz, chief economist of the National Association of Home Builders, puts it. Everyone was surprised by how long the real estate celebration lasted. According to the National Association of Realtors, median prices hit a record high of over $400,000 in the spring of 2022. Despite a recent drop, NAR statistics show that prices are still up a healthy 32% since the coronavirus outbreak started in March 2020. As a result, competition between buyers has subsided, supply is expanding, and the bubble has burst. In his capacity as chief economist for the NAR, Lawrence Yun has seen a clear turning in the market. Housing market crash in the long term. It wasn't until 2005 and 2007 that the U.S. housing market became so bubble-like. Suddenly, the housing market collapsed, causing widespread suffering. As the housing market crashed, it caused the worst economic crisis since the Great Depression. Now that rising mortgage rates and the possibility of a recession are posing a danger to the housing bubble, prospective buyers and current homeowners are asking a common question. Is the housing market so hot that it is going to crash? Experts in the housing market predict a drop in values, but they say it won't be as steep as what homeowners saw during the Great Recession. The personal financial stability of homeowners today is far higher than it was 15 years ago. Most mortgage holders have cheap interest rates, substantial equity, and a solid credit history. This means there is no imminent threat of a housing catastrophe due to foreclosure. According to Molly Boesel, senior economist at CoreLogic, the wild ride known as the U.S. housing market slowed drastically in the autumn of 2022 as mortgage rates soared and house values remained high. Household purchasing activity skyrocketed at the beginning of 2022, only to crash and burn by year's end. Although many homeowners will be spared the foreclosure crisis that plagued the country during the Great Recession because of the substantial equity they built up in their homes. Construction firms are also proceeding cautiously because their members have not forgotten the Great Recession. As a consequence, there is now a severe lack of available homes in the market. "We don't have enough stock," explains Lawrence Yun. When an interviewer asked, "In certain markets, do you expect to see prices fall?" "Sure," he replies. "It's quite improbable that prices would drop by 30% again because of a lack of supply." Economists have been predicting a slowdown in the housing market for months now, with the main reason being that rising property prices are becoming a victim of their own success. Mortgage rates quadrupled from August 2021 until recently, adding insult to affordability concerns brought by soaring home prices that have outpaced wage growth. Experts predict that home prices could fall. High single-digit price drops are what most markets may expect, according to Dietz's forecast. A drop of 8 to 9% in home prices would hurt the economy. While home values did fall by as much as 50% in certain areas during the Great Recession, this correction will be mild in comparison. ATON Data Solutions Executive VP of Market Intelligence Rick Sharka predicts a 5% drop. He predicts that housing values will continue to fall. Yun claims that high-priced areas like California are the most susceptible to price drops. Yet property prices are unlikely to go down in the Midwest. For the country as a whole, he anticipates no price changes in the next year. Reasons the housing market is not going to crash. Housing analysts provide 5 solid reasons why a crisis is not near. We still have very low stock. According to the National Association of Realtors, the inventory of available properties in December equated to 2.9 months. Because of the persistent shortage of goods on the market, many purchasers continue to have no option but to pay ever-increasing prices. Also, this demonstrates that a price drop is unlikely since basic economics dictates otherwise. The construction industry can also not keep up with the soaring demand. The housing industry drastically scaled down following the previous recession, and it has yet to recover to its pre-2007 levels. They can no longer meet demand since they cannot acquire land or get necessary permits fast enough. While they are putting up as many structures as they can, it seems unlikely that the overcrowding of the last 15 years will happen again. Bankrate senior financial analyst Greg McBride, CFA, explains the price increase as a result of increased demand and a deficiency in supply. Supply and demand may find equilibrium again if builders increase the number of houses for sale, if more homeowners decide to sell, and if potential purchasers are priced out of the market. Nothing like this can be accomplished quickly, however. New consumers are being created through demographic shifts, as several factors contribute to the high demand for housing. For instance, when the popularity of working from home increased during the epidemic, many Americans who already own a house realized they needed more space. This generation of young adults is a massive market with a lot of spending power. Hispanics are a youthful and rapidly rising group that has a strong interest in property ownership. Lending criteria still remain to be strict. In 2007, it was typical for borrowers to get liar loans or loans without the need of proving their income. Mortgages were available from many different banks and financial institutions for borrowers of varying income levels and down payments. Although, today's mortgage applicants must meet stringent requirements set by lenders, and the vast majority have outstanding credit histories. According to the Federal Reserve Bank of New York, the average credit score of mortgage borrowers in the third quarter of 2022 was a very high 768. McBride warns that things might change drastically if lending standards weaken and the market returns to the wild, Wild West conditions of 2004 and 2006. We worry about a collapse if we see prices being pushed up by the false purchasing power of weak lending rules. There hasn't been much action in the foreclosure market recently, which is good news since the oversupply of foreclosed homes that flooded the market in the years after the housing meltdown drove down values significantly. This is no longer the case. The majority of homeowners have built up a sizable equity reserve. During the height of the epidemic, lenders stopped sending out default notices, leading to historically low numbers of foreclosures in 2020. The sum of these factors points to an agreement that housing costs are, indeed, at or near their maximum sustainable level. Therefore, this boom should not end in a crash. That's all for today, guys. If you like this video, be sure to leave a thumbs up, subscribe to the channel, and press the bell icon for